And as we said, gold reaching its highest price once again today. We're going to talk more about this now because we want to know what is the best way to play it now that gold keeps going higher and higher. Joining me now is Thomas Winmill. He's the manager of the MIDAS Investors Fund, which has about $150 million in assets under management. About 90% of that is in gold mining as opposed to the metal itself. So, Tom, thanks for coming in.
Oh, it's a pleasure to be here.
Another day, another record for gold. Let's talk about this first before we get to some of the mining stocks, because obviously the two are linked. When you look at gold prices, you know, how much do you say is speculation at this point, and how much of it is justified? Well,
I'd say there is a euphoric factor in there, maybe $50 an ounce, more or less. I think there is some fundamental reason, though, to own gold at these levels. The fear factor is the hardest part to invest, the way to invest in the gold, and that's reflected in the euphoria or the fear in the market right now. But I think the medium-term supply and demand factors are good. The longer-term factors are particularly favorable for gold. In other words, the monetary policy of the U.S. and the fiscal factors in the United States itself.
But what about when the Fed starts to raise rates once again? Even if it's not going to happen all of next year, could happen in 2011. That could make the dollar reverse its declines and could present some problems for gold, perhaps.
Oh, indeed. Higher interest rates usually are bad for gold, so I'd be on the watch for that. But another way of looking at higher interest rates is to compare it with the inflation rate. And the real thing to look at is real inflation rates, or real interest rates. So take the interest rate and subtract the inflation rate. If it's negative, a negative real interest rate, that's positive for hard assets such as gold.
And you think that's going to happen even after rates start to go up?
Well, the Fed seems to be following the trend. There is a little tick back now we've seen in the CPI, the PPI. It's all coming back with higher oil prices, higher commodity prices generally. I'd say the Fed is behind the ball now and probably will remain behind the ball.
So if you think gold is going to keep going up, let's talk about what to do with gold stocks. Now, looking at these stocks as a group, and even some on an individual basis, many of them have far outpaced the gains in gold itself. So why is it still a good idea to get into these guys?
Well, I'd say the gain of the gold equities over gold is attributable to two reasons. One, it's coming back from very low valuation levels. In other words, price to cash flow, price to earnings. They were very compressed last year at this time. The other reason is that mining companies, well-managed ones, have operating leverage. In other words, their pre-tax profits will go up, say, at twice the rate of a gold appreciation because of their inherent costs. So what we like to see at MIDAS are growth companies in the gold sector producing more volume. So they'll not only get a pickup in revenue because of higher gold prices, but also because they're producing more ounces of gold.
Now, to get back to the first point for just a minute, when you say they're coming from low valuations, now the PE ratios of many of these companies are relatively high. So, I mean, are they getting a little rich? Do you have to look for some of the gold miners that are still at low valuations?
I think so. That's a really good point, Julie. I'd say some of the miners, I'd say the bulk of them are kind of in fairly valued territory. It's certainly not the bargain levels of last year, but there's some that have kind of broken wings.
So which ones?
Well, I like Agnico-Eagle. It got pounded when they announced a higher operating cost, kind of a schedule of mine development that wasn't what investors expected, but it's still a great management team, well-financed, and some really interesting growth prospects ahead. Another one that's been maligned a little bit is Newmont. The new CEO there, it's a couple of years old, has really been bringing that operation around an attractive situation. A third one could be Jaguar. We've loved that one for a long time. It hasn't really market hasn't realized the fact that this is a substantial grower from 115,000 ounces last year to maybe 600,000 ounces in about 5 years.
Well, if these companies have a lot to gain when pre-tax profit-wise when gold prices go up, how vulnerable are they going to be once the prices start to go down?
Well, that's just it. That's the reason why you want to own a grower, because even if gold prices go down, their revenue should stay flat or go up a little bit if they have more ounces under production. So the ones most vulnerable are the higher cost ones with a steady or declining growth production. So watch out for those. That's the reason why if you're going to go in that direction, go with Newmont or a bigger cap one that is already well supported in the market.
Now, you talked about that gold as a good long-term play. I mean, if you're looking out to 2011 when rates could be going up, could see some vulnerability there potentially. So, I mean, how long-term are we talking here? And just quickly here.
For the gold price?
Yes.
Well, we're seeing a double over 10 years because of the money supply, office management budget, $10 trillion overspend in the next 10 years. But what I'd like to see, MIDAS Fund will probably at that time be in industrial metals.
Okay, Tom, unfortunately, we're out of time. My thanks to Thomas Winmill.